So we talked about the balance sheet. Now we're going to talk about the income statement. Just remember, we're talking about three financial statements in this class: the balance sheet, income statement, statement of cash flows. The income statement are the results achieved over a period of time, and they flow back up to the balance sheet. They flow back to the balance sheet via return earnings that are retained in the business. Balance sheet is economic resources under our control. Income statement is the results achieved using those resources. What did we gain by using those resources in the year, and cash flow is how we finance those. So if we think about the balance sheet equation, we can expand it. So we have assets on one side, all our resources, and then the claims to those resources on the other side, liability, stockholders' equity. But we can actually expand the equation out. And if we expand the equation out, we actually can discover the income statement. So stockholders' equity can be expanded to paid in capital and retained earnings, right? Paid in capital is the equity investment, and the retained earnings are the earnings retained in the business. And you'll notice I have these little T's here. That's for time period of a given T. So you say 2020. And if there's a T minus one, that's 2020 minus one, which would be 2019. So we have stockholders' equity, assets, liabilities, paid in capital, and retained earnings. And then the retained earnings is the beginning balance of the retained earnings, so T minus one, so the prior year retained earnings, plus net income minus dividends. All right, dividends are what we pay back. That's what will get retained and added to the balance of retained earnings in a given year, net income minus dividends. And if we break up net income's made up of, revenues, expenses, gains, and losses. And this is where our income statement is. So this is how it flows through to the balance sheet. And this is the articulation example: revenues minus expenses and gains and losses gets you to net income. Net income, beginning retained earnings plus net income minus dividends gets you your ending retained earnings balance that goes back to your balance sheet, and in your balance sheet account for retained earnings, which is under owner's equity. So there's two types of actions: economic increases, economic decreases. And if you have an economic increase, your debate is between a revenue or a gain. An economic decrease is an expense or a loss. Net income is the net of these two transactions, right? So you'll have revenue / gains, economic increases, expenses or losses, economic decreases equal net income. And the result, that's the results for the period of time. There's a distinction between the terms, often subtle and confusing. What do I mean by that? Revenue is not the same thing as gain, and it matters. It matters. And the difference in the name is significant because it tells us where we're getting the money. Revenues and expenses are associated with our operational transactions. So, for example, if you're in the swimming pool business, and let's say you need shotcrete, which is used to put inside of pools, revenues and expenses, the expense of a shotcrete inside the pool would be, shooting inside the pool that's an expense. That's part of your business. Let's say you have a machine that is hard to get that helps you with, making a unique feature in a pool. And all of a sudden you could sell it, and you do sell it, and you get a lot of money for it. Well, guess what? That's not your core business. That's something outside your core business. So that would be classified as a gain, not like a revenue. And it'd be a gain because your business is making pools. Your business isn't, selling this unique form of equipment. So the way to think about it is this a job that we normally do? And if it's a job that we normally do, if it's something that's a normal, regular, reoccurring type of thing, we're going to put revenues and expenses. And if this is a unique type of thing, something that doesn't happen that often, we're going to put it as a gain or a loss. And so generally, revenue recognition rules fall into these two buckets. This is a very simplified way to talk about revenue recognition. And if you answer these two questions, you're pretty solid for having revenue. These rules have changed a bit in the past, but for this purpose of this class, this question will help you answer it. What's the status of the job for revenue recognition? Is the job done? If you've done the job, great. Then you potentially have revenue. You have to answer the second question is, what is the likelihood of payment? If you have done a job, but you're probably not going to get paid, then you don't have revenue. If you've gotten paid, but you're not going to do the job, you don't have revenue. You have to do the job, and it has to be likely that you paid. Expenses represent an asset used or liabilities incurred by generating revenue. So this is cost of goods sold. This is like the inventory you sell, the marketing, general, administrative expense, research and development costs, interest expense, income tax expense. We use what's called the matching principle for expenses. So you want your expenses to happen in the same period that your revenue happens. So if you have created an asset and you plan to sell it, the cost of creating it, you capitalize, meaning you put it on the balance sheet and you increase it, and you don't count it as an expense until it leaves and you have a claim of some sort of revenue for it. So you match your revenues and expenses in the same period. So this is an example of an income statement, revenues, costs of sales, gross profit, selling and general administrative expenses. These are the overhead costs of running the business, research and development costs, operating income, interest expense, other expenses and losses. And you'll notice at the top, we kind of go to revenues and expenses, and then lower, we talk about gains and losses, right? And gains and losses, it's important to have this distinction because we want to see what is the sustainability, like how long will the company actually be able to be profitable at this certain thing? And then, what are some one-off things that might have happened? And you can imagine the incentives here that, managers sometimes want to put things that are bad as, oh, this is a one-time loss. This isn't a real thing that's part of our regular operations. And they also want to make gains. They want to say, oh, no, this is something that happens all the time as part of our revenues, right? This is a part of it. And so that's the incentive of managers. But for financial reporting purposes, this is what you split them based on the activity and where the activity happens. So similar type of formula, determine if it's an asset, liability, revenue, expense, gain, or loss for determining names, and then describe it, all right? So describe what it is. So revenues, sales. Sales is a great account for calling it. You call it sales revenue. You could call it sale. Fee revenue, interest revenue, rent revenue, all these things. If this is an economic increase that you're getting and it's something related to your business, that's what you do right there. Expenses, cost of goods sold, wage expense, rent expense, depreciation expense, advertising expense. You can just it's this name thing is pretty simple. You put expense on most things and it will usually mean an expense unless it's a prepaid expense. Don't forget, prepaid expenses that's an asset. That's not an expense because it's a resource that you've got to use. We talk about that in the prior video. The income statement flows into net income, retained earnings, and goes down to the balance sheet, right? This is the expanded equation. How this works in the articulation process, remember, you have your beginning balance of your balance sheet and you have your ending balance. Your net income kind of does the path walk for retained earnings, and it shows you, revenues, gains, losses, and expenses, and your performance. And that's how you bridge the gap between your balance sheet from the prior year and this year. Is it goes into your retained earnings and it helps update your retained earnings balance. So that's it for the income statement. We're going to talk about some examples in the next video.